What's up, crypto fam? Welcome back to the Crypto Breakdown Whiteboard mini-series. In today's video, I'm going to teach you everything you need to know about leverage trading, exchange fees, and funding. I'm going to start off by reading the high-level explanation, and then I'm going to break it down in layman terms, and if you stick around at the end of the video, I'm going to teach you how my buddy Kite Crypto made over $1 million keeping a $20,000 25x short on Bitcoin open for 459 days before he got liquidated. And yes, you heard that right. He got liquidated on a trade for $20,000 and still made over $1 million. So don't leave early and smash that like and smash that subscribe button. So what are BYBIT funding fees? Perpetual contract trading is similar to future contracts, whereby traders can leverage up and don't exchange the underlying asset on the spot exchange. The main difference between the two is that perpetual contracts have no expiration date, which means that in theory, traders can keep these contracts open technically forever. Without a fixed delivery date, the contract price and spot price may never converge. In order to anchor the perpetual contract trading price to the spot price, the funding mechanism is to ensure BYBIT's latest trader price is always anchored to the global standard spot prices. Here's a brief overview of how it works. Should the trading price sit above the spot price, long position holders will pay the funding to short position holders. This incentivizes traders to open more short positions and bring down the trading price, shifting towards the spot price. So let's say that the trading price is lower than the spot price. In this case, short position holders will pay the funding fee to long position holders, so that the latter is placed in the driver's seat to open more positions. Thus, prices are driven back up, achieving a similar objective to narrowing the spread. So what does all that mean? Number one, the purpose of funding is to incentivize traders to take positions on the opposite side of the majority. So when a majority of the market is bullish and there's more traders placing buy orders than sell orders, the traders who are placing long positions start paying funding. When the market is bullish, long positions are paying funding. When the market is bearish, the shorts are actually paying funding to the longs. For example, if we swing over to BYBIT right now, we can see that the funding rate on Bitcoin is 0.01%. So that means that if I were to open a Bitcoin long right now for $20,000 with 25x leverage, I would be paying funding. When funding is positive, longs are paying funding to shorts. When funding is negative, shorts are paying funding to longs. Funding is paid every 8 hours. So let's use 8 a.m., 4 p.m., and 12 a.m. as an example. If funding is paid every 8 hours, people would pay funding 3 times a day. But if I open a trade at 7:30 a.m., 30 minutes before the next round of funding starts, I would still pay the 0.01% fee as soon as I open my trade. And then at 8 a.m., if my trade is still open, I would pay another 0.1% again, and again, and again, and again, every 8 hours on the dot. So let's break down a trade together. When we are talking about leverage trading, a lot of people think that they are only paying fees on the amount that they bet. If I opened up a $1,000 25x long, people think that they're only paying fees on the $1,000 because that's what they bet, but that's not the case. They are actually paying fees on the entire size of the trade, even with leverage. So if I placed a $20,000 long with 25x leverage, the most money I could lose in the trade would be $20,000 because that is the size of my bet. But with leverage, the size of my actual trade is 20,000 times 25 because I'm using 25x leverage, giving us a total of $500,000. So if the funding rate is 0.01% and I open my trade at 7:59 a.m., the second I open my trade, I would pay $50 in funding. And then 2 minutes later at 8:01 a.m. on the dot, I would pay another $50 in funding. And then again at 4 p.m., I would pay another $50 in funding. I think you get the idea. Now let's talk about trading fees. So just like we explained above, if you open a trade for $20,000 with 25x leverage, the total amount, the total value of your trade would be for $500,000. So BYBIT has 2 different ways that you can open a trade. You can market in and be a taker, or you can limit in and be a maker. When you market into a trade, you are paying a taker fee of 0.06%. So I would pay 0.06% fee to open the trade, and you also pay the same 0.06% fee when you close the trade as well. Now, if you place a limit position, you become a maker because you are making price come to you and you are adding liquidity to the order book. When you place a limit position, you become the maker, so you're only paying a 0.01% fee. Let me show you the math, and then I'll explain the difference between maker and taker. So let's say we market into a trade at 12:01 a.m. and we place a $20,000 25x long on Bitcoin and funding is 0.01%. The trade size would be $500,000. The market fee to open that trade would be 0.06% times 500,000 would be a $300 taker fee to open that trade. The funding fee would be 0.01% times 500,000 equals $50. Now let's say 30 minutes later we close that trade, we would also pay that same 0.06% times 500,000 equals $300 in fees to close the trade. $300 fee to open the trade, $300 fee to close the trade, and $50 in funding because we only ran through one 8-hour interval of funding. Now if we limit into that trade and we become a maker, we would pay $500,000 times 0.01%, which would be $50. Now it's super hard and dangerous to close out a trade with a limit position. Even if you limit close a trade or you put a stop loss in place and it hits a limit and closes out that trade, most of the time you're still paying the maker fee unless you check the post button, and it's way over your head. So just assume that anytime you close out a trade as a trader, you're almost always paying a taker fee. So when you close out that trade, you're going to pay the 0.06% to limit close that trade. So if you limit it into that same $500,000 trade, to open the trade, you're going to pay $50 to open it. Close the trade, you're going to pay $300, and you're going to pay $50 in funding. Total $400 to open and close a $100,000 position inside of an 8-hour period. So if we take a look at this chart on BYBIT that explains the difference between a maker versus a taker fee, you can see that at the top that it says makers add liquidity and takers remove liquidity. What liquidity means is the amount of limit orders that are on an order book. If you've ever bought or sold crypto on a centralized exchange, I'm sure you've seen an order book. It looks just like this. Right now, if I were to place a limit order on Bitcoin for $20,000, what would happen is my trade would be added to this order book, and I would be adding liquidity because my order is now added to that book. And if somebody wants to sell their position or price goes up into that position, I'm gonna get my order filled. So let me swing over to BYBIT really quick and show you how this works. So now if we swing over to BYBIT, what an order book is, order book shows you people that are taking trades in the future. When you place a limit buy order, for example, if you wanted to DCA into Kadena and you said, hey, I want to buy Kadena if it comes down to $1.33 right now. And you come over here, you type in $1.33 and you say, hey, I want to buy 100 Kadena and I want to open a long position with 5x. If you hit that open trade, what it's going to do is it's going to put a limit order down here at $1.33. And if price comes down to $1.33, it's going to fill your order. And what that does is it tells the world, hey, there's 50,000 people over here willing to sell Kadena or willing to buy Kadena at $1.33. So that means if there's a big whale and he wants to sell a lot of Kadena, there has to be somebody that's willing to buy it if he sells it. So this is where you see our order books. The red is sell orders, the green are buy orders. So if I swing over to the spot on Kadena and I click the red order, this is a list of everybody that's selling Kadena. So you see $1.43, $1.44, $1.45. If I wanted to sell 10,000 Kadena, there's not $10,000 worth of people that are selling their Kadena. So even though price is at $1.43, let's just say I wanted to market buy $100,000 worth of Kadena, or say 10,000. There's not $10,000 worth of people selling Kadena at $1.43. So I would buy 2,000 at $1.43, 124 at $1.44, all the way up $1.46. I'd buy 123 because there's not that much liquidity over here. Not many people are selling it. Now, if you choose this drop down and go down to the lower increments, it'll group them. So at the $1.50 range, there's $13,000 worth of people that are willing to sell you Kadena. At $1.60, there's 1,442. So if somebody came over to BYBIT right now and they wanted to buy 20,000 KDA, and they just put an order in here for $20,000 and they hit market and buy, what it's going to do is it's going to buy you 12,000 at the $1.50 range. It's going to buy you 1,442 at the $1.60 range, and it'll just go all the way up. So if you've ever seen that crazy wick on Binance, so this is exactly what happened on Binance US. somebody over here placed a market buy order and they ate up all that liquidity. A guy ended up paying $7.90 for a Kadena because he ate up all of the liquidity on that order book. So that is the purpose of funding. When there's more traders that are going on one side, what funding does is it goes in the opposite direction to incentivize people to take trades on the opposite side. So when the market's bullish right now on Kadena, I mean, even though it's bearish, almost always funding is always positive. Longs are almost always paying funding. I'd say 90 to 95% of the time, long positions are paying funding. So if we scroll down here now and we take a look at my Kadena position, I have a long position on Kadena for $1,667. That is the size of the position, but the total value of the position is $8,315. I've had this position open for about 2 weeks, and you can see that I've paid $52 in funding. So we can swing over and check out this percentage calculator. It's really easy to use. If I just type in what is funding, 0.01%, what is the size of my position? The size of my position is $8,315. So that means every 8 hours, I'm paying 83 cents in funding. I'm paying that 3 times a day. So to keep that trade open, I'm paying roughly $2.49 per day. So if I divided 55 divided by $2.49, it's showing that I've kept that trade open roughly for 22 days. But I didn't include the fees that I paid to open and close that trade. So you can see I've had that trade open for roughly, looks like 20 days, give or take. Now let's talk about how my buddy Kite Crypto absolutely crushed it on this Bitcoin short and how he was just racking up the funding. Now when we're shorting with USDT perpetual contracts, and there's also coin margin contracts. So right now, if I want to short Bitcoin, I'm using USDT. So I got USDT in my portfolio, I bet in USDT. But if I had Bitcoin in my portfolio and I wanted to bet with Bitcoin, what I'm doing is I'm using what I think are called coin margin contracts. So he did it with Bitcoin. The difference is when you bet with USDT, you're paying funding and you're also getting funding in USDT. When you bet with Bitcoin, you're paying funding in Bitcoin, but you're also getting paid funding in Bitcoin. So he did a short with coin margin contracts. He shorted with Bitcoin, right? Inverse perpetuals. So every 8 hours he was getting paid funding. And remember what we did earlier. If you had a $20,000 trade with 25x leverage, every 8 hours you'd be making $300 in funding. So he held this trade open for 459 days. And don't quote me on these exact numbers, not sure on the price of his trade or the exact point, but you guys will get the idea. So he held this trade open for 459 days. $20,000 25x trade makes you $300 every 8 hours, and he was getting paid that funding in Bitcoin. He started shorting the peak of the 2029 mini bull run, and he held it all the way to the 2021 bull run before he got liquidated. Let me show you guys. So if we take a look at the mini bull run back here in 2019, my buddy Kite caught a short on Bitcoin up here. And again, don't quote me on the exact amounts, but he caught the short right at peak here and he had just crushed it, longing it up. So I guess he was betting pretty big. It was 10,000, 20,000. I don't know the exact amount, but he held that short all the way from here, all the way across. And you can see right here is 483 days. That's legit how long he held this trade open. He shorted this peak. Instead of taking profits, he realized that every couple days, he was making hundreds and if not thousands of dollars in Bitcoin. I mean, just crazy. So every 8 hours as Bitcoin came down, his position was still the same size position, right? So he's getting paid funding. So he used this to DCA him into Bitcoin. So he got paid funding. And the only time he was actually paying funding was like on this stretch right here. Like this one candle right here, he was paying a little bit of funding back. This one candle right here was paying a little bit of funding back. But for a majority of the time, the market's always bullish. So since he was short, and the reason that he just let himself get liquidated, because what if price came up here to say 12,558 and then came back down for another 100 days? I mean, there was no need for him to even risk closing that trade out. It was such a great position that he got himself into, and he was able to keep that trade open this entire time. So for 490 days or 480 something days, he was actually getting paid in funding and it was DCing him into Bitcoin. So just imagine how much Bitcoin he ended up with when we went up here into this bull run. I mean, pretty large sum of Bitcoin in my personal opinion. So pretty crazy story about Kite's trade, isn't it? Drop some comments below. Let me know what type of videos you guys want me to do next. If there's anything about trading that you don't understand, drop some comments below. Let me know what you guys think of this video. Smash that like button, smash that subscribe button. I'll catch you guys in the next video.